Reserve Bank of Australia holds back on further easing, deciding to hold its cash rate at 2.25% in data out today. Now talking through this decision and more data coming from the Antipodes, I'm joined by Paul Dales, Chief Australia and New Zealand economist with Capital Economics. Welcome, Paul. Now firstly, why do you think Australia's central bank has chosen to hold rates steady?
Well, I think the main reason is that the RBA was concerned that back-to-back rate cuts after having reduced rates in February would stoke house prices by more than they could really stomach. So although there are signs that the domestic economy is weakening, it's quite clear that the housing market is pretty much on fire, and the central bank didn't really want to add fuel to that fire. Now that doesn't mean that the central bank isn't going to cut rates further. In fact, in its policy statement announced today, it pretty much suggested that it will do, but it's just not ready to do it yet. And at Capital Economics, we think that by the end of the year, interest rates in Australia would have been reduced all the way to 1.5% from the current 2.25%.
Australia's GDP report will be out tomorrow. Should we be seeing a rise? And could this cause Aussie dollar movement?
Well, tomorrow I think the GDP figures will actually look a bit better in the fourth quarter of last year than they did in the third quarter. So if you remember, in the third quarter, GDP rose by just 0.3% quarter on quarter. And I think we will see an increase of around 0.7% in the fourth quarter of last year. But I don't think that's really anything to get too excited about. I think the Australian economy is going to slow down this year as the plunge in mining investment takes a toll, and as the hit to national income from the sharp fall in commodity prices reduces investment and employment in other areas. So while tomorrow's figures could give the Australian dollar a little bit of a boost against the US dollar, my overall feeling is that in over the next 6 to 12 months, the Australian dollar will actually weaken further against the US dollar.
Now looking over to New Zealand, ANZ commodity prices out earlier today. Movements in the subsectors showed dairy on the ascent, but the rest of the sectors were either treading water or experiencing some declines. How should we be interpreting this data?
Well, the New Zealand economy isn't as weak as the Australian economy. Nonetheless, it is also going to have to absorb quite a big hit from a decline in prices of its main commodity exports. In this case, dairy prices, which fell very sharply last year. Now, in that sense, the increase in dairy prices in the first few months of this year is actually reasonably positive. But that's only if you just look at the prices. If you actually look what's driving prices higher, unfortunately, that's the drought in the east coast of the southern island. So that means that although farmers are getting a higher price for each product, they're probably actually going to sell fewer products because the supply has been hit by the drought. So it's not as positive as it would seem at first sight. So my view on the New Zealand economy is that it's certainly in a better shape than Australia, but it may too weaken this year, perhaps with growth slowing from around 2.8% last year to around 2.3% this year, and that would be a much weaker outturn than the Reserve Bank of New Zealand currently expects.
That was Paul Dales from Capital Economics joining me there. That's all from myself for now. Thanks for watching, and remember to keep tuning in to Dukascopy TV.